the economic data continue to perplex and divide even the supposedly united front at the Federal Reserve. As we all know, getting a grip on inflation has been the central preoccupation for monetary policymakers over the past year. But the latest figures suggest this quest remains stubbornly elusive. In his speech at Stanford this week, Fed Chair Jerome Powell acknowledged the bump in inflation readings, though he insisted it doesn't necessarily derail the broader disinflationary trajectory. Reading between the lines, it's clear this remains mostly an article of faith, or at least fervent hope, on the part of the central bank. The Core Personal Consumption Expenditures Price Index, the Fed's preferred gauge of underlying inflation, accelerated in both January and February, posting the largest back-to-back increases in over a year. This prompted many analysts to recalibrate their calls for when the first rate cut might come, with some pushing their forecasts from June to July. Of course, the Fed's decisions shouldn't merely respond to short-term data fluctuations, but strive to look through the noise to discern the underlying economic fundamentals and medium-term outlook. And on this front, Chair Powell expressed cautious optimism about further supply-side gains that could relieve lingering inflationary pressures. He cited surveys showing businesses still grappling with labor shortages and supply chain woes, precisely the types of constraints that have stoked inflation over the past couple years. If these bottlenecks can be cleared, went the implication, inflation may find a more durable downward glide path, yet any gains on the supply side seem likely to be incremental at best. More profound upside surprises, say, from a surge of immigration or technological innovation, would be welcomed by all but seem improbable. The reality is that reversing the inflationary psychology that has taken root will likely require a more extended period of subpar demand growth. This would entail some economic pain, at least temporarily, in the form of higher unemployment and weaker business conditions. It's the very scenario the Fed has been laboring to avoid through its much ballyhooed soft landing. Of course, even a mild recession would be preferable to the truly virulent strain of stagflation, high inflation coupled with stagnant growth, that proved so pernicious in the 1970s. But as each passing inflation report demonstrates, the narrow path to immaculate disinflation seems to be narrowing further. The Fed's inescapable bind was summed up well by Governor Adriana Kugler, who acknowledged that continued moderation in inflation may ultimately require some cost to jobs or the broader economy. In other words, stable prices and robust employment may simply be irreconcilable objectives, at least in the near term. While hardly a novel insight, it gets to the fundamental quandary haunting the Federal Reserve. Its legal dual mandate charges it with both price stability and maximum employment imperatives that are interdependent in normal times, but can veer into direct conflict in abnormal circumstances like these. In the end, the Fed's mandate prioritizes inflation over employment. But it's clear Chair Powell and his colleagues remain deeply conflicted over just how much economic pain they'll be willing to stomach in pursuit of their 2% inflation target. For a central bank that prides itself on operating above the political fray, these are decisions fraught with weighty societal trade-offs extending well beyond the arid realm of econometric models. All of which leaves the Fed calibrating in an extended twilight zone of uncertainty. How much more inflation risk are they willing to tolerate, even if means prolonging the economic upheaval? Or might a deteriorating growth outlook compel them to hit the brakes on rate hikes, even if inflation remains stubbornly high? These are the existential dilemmas that Jerome Powell and company must weigh, even as they profess a strictly technocratic adherence to the incoming data. Rest assured, the human element of judgment, anchored in one's broader philosophy and core values, will ultimately carry the day. For this is the eternal tension of American economic policymaking, dating back to the nation's founding. Do we prioritize order and stability, even at the cost of curtailing economic vitality? Or do we embrace the Energizer Bunny spirit of perpetual motion and creative destruction, come what may in terms of turbulence and human dislocation? There are no clean resolutions, only hard choices shaped by one's underlying premises about the hierarchy of economic objectives. The Fed's prioritization of stable prices over full employment hardly settles the matter, it merely kicks the debate to a higher plane regarding the acceptable sacrifice of the latter to achieve the former. As is ever the case, these debates over technocratic policies are really proxies for more primordial value clashes that have riven society since the dawn of civilization. Order versus freedom, security versus opportunity, roots versus wings, the polarity endures in new guises with each passing generation. And perhaps it's fitting that the stewards of American economic destiny find themselves caught in the same existential crosscurrents buffeting the nation writ large. For the Fed's mandate emerges from that same constitutional cauldron of competing values, of democracy's eternal tug-of-war between dynamism and durability, between the rights of the individual and the collective imperative for social cohesion. Such is the perpetual struggle of the American project and the one we observe unfolding today between those green doors at the Eccles Building. The ideological divides may be starker and the stakes even higher, but the essential choice remains hauntingly familiar. Just another battle in modernity's eternal culture war, fought on the terrain of interest rates and inflation data rather than on the ramparts with muskets and cannon fire. And through it all, the quest for economic equilibrium endures. The very pipe dream, one could argue, of a society founded on the revolutionary notion of rejecting the old certainties and hierarchies in favor of a perpetual experiment in self-governance. Perhaps our economic other growing pains are just the latest skirmish in this audacious civilizational saga. So take solace in the timeless cycles underlying the Fed's current bewilderment. It's simply one more plot twist in the great American drama stretching back to 1776. We may cast central bankers as the ringleaders of the economic circus, but they are but bit players in the larger struggle that's defined the nation from its very inception. Caught in the perpetual crossfire between the dueling imperatives of order and chaos, stability and disruption. In that light, perhaps we should grant the Fed's policymakers a modicum of grace as they muddle forward in pursuit of a sustainable equilibrium, however chimerical that prospect may ultimately prove. For like the American experiment itself, the quest to reconcile our competing economic appetites is an ongoing improvisation more than a final destination. A never-ending journey marked by periodic upheaval and course corrections, but one bounded by firm ideological anchors deeply rooted in our collective mythology. So maybe the inflation turmoil should be welcomed as just another mile marker in the nation's relentless forward march. The birthing pangs of a new economic order, formed from the ashes of the old. Progress can't be achieved without a measure of pain and dislocation along the way. Regardless, the show must go on. And maybe that's the ultimate solace afforded by this endless economic churn. That out of the current tumult, a new equilibrium will ultimately emerge, however fleeting. Just as it has through every previous crisis, real or imagined, in America's storied sweep across history's grandest stage.